Yeah. Good evening, everyone. Welcome to you all to today's our webinar on Internal Controls and Audit Committee, Strengthening Corporate Governance Through Effective Oversight. So we are delighted to inform all our participants that today we are going to dive into such a critical aspect of corporate governance. And to start, I would like to welcome on behalf of our chairman, sir, CA Dr. Devashish Mitra, sir, past president ICI, and also a chairman to Expert Advisory Committee. And we are honored to just inform all our participants that today we are having with us the featured speaker, CA Vivek Nevatia, sir, with his extensive experience in business valuation, statutory, forensic, and investigative audits, corporate finance, and business restructuring, mergers and acquisition, takeover, and business advisory. Sir is going to share his experience in the audit and governance, and this will bring a wealth of knowledge that will undoubtedly enhance our understanding how robust internal controls and active audit committees can strengthen the corporate integrity and accountability. So with this, I would like to invite Sir to take forward the session and enlighten us with his shared thoughts, share the views, points, and its thought process on the today's topic. Welcome, sir.
Thank you. Thank you, Nishaji, for the introduction. And thank you, Corporate Laws Committee, for inviting me to speak on this topic on internal controls and audit committee, strengthening corporate governance through effective oversight. So I'm really thankful for inviting me to speak on this. This is a very relevant topic today, considering the increased oversight, regulatory oversight on the topic of corporate governance. And what we have seen over the recent past 10-15 years, after the Companies Act 2013 has been introduced, there has been an increased regulatory oversight on audit committees as well as auditors in respect of how the governance is there. Even we as investors, when the equity markets have improved significantly, and there's so much of capital flowing into the company, into the country, we have now realized that corporate governance is something which is a critical aspect to assess whether a company is doing well or not doing well. One of the key parameters which we analyze before investing into a company, is whether the company has a good corporate governance. And this corporate governance is or can be strengthened or established through an effective system of internal control and an effective audit committee, which is there as a link or a connect between the board, between the external stakeholders and the management. And if this audit committee and the internal controls are not properly established, I think it is very difficult to establish corporate governance, let alone be strengthening corporate governance. So I think the fundamental basis of establishing corporate governance is through an establishment of a basic internal control system, a strong internal control system, as something which can be relied upon by the external stakeholders, and an audit committee which looks at whether this system is working and operating effectively. So today we all understand that in the increased globalization era, wherein so much of foreign direct investment is coming in, Indian companies are going abroad. This poses its own unique set of challenges. We have seen that organizations which have weak internal controls have suffered failures, financial failures, have resulted in huge high-profile scams, and also we have seen financial statements being revised due to significant misstatements with them. So we'll understand during the course of the presentation how strengthening these internal controls and using audit committees effectively, we can avoid those possible issues. So today what we will basically discuss during the course of the presentation is very summarized and very crisp. What we'll do is it will be more of my deliberation that will be there on how internal controls and audit committees will result in strengthening of the corporate governance. We'll discuss of the evolving role of audit committees in today's governance structure. Why internal controls form the backbone for any governance framework. So we'll discuss this, why internal control is the nervous system of the entire organization, and these internal controls should be given primary focus whenever we look at an organization. We look at certain practical examples of risk management, how fraud should be prevented, and how audit committees can oversee IT and operational risks. We'll look at future trends in corporate governance, how the sustainability and the digital transformation is shaping the organizations today. There is a buzzword known as ESG, which has evolved over the last 3 to 4 years, post COVID particularly. And we'll look at those whether the audit committees and internal controls, how do they fit in into the ESG framework. So before starting off with the next slide and uh, before starting off with the next uh, idea of corporate governance, I'll just request everyone to think about their own audit committees, or how, if you're not associated with an audit committee, as an auditor, when you interact with an audit committee, how do you see that audit committee's role evolving over the last 3 4 years? Have you identified any changes with respect to the evolution of the audit committee role? Whether the audit committee's role has significantly increased? Do you feel that in your organization or in the organization where you are auditing, the oversight over the internal controls could be better? And whether if that oversight is stronger, whether the you as an auditor or you as part of the management or as part of the audit committee, would you feel that the comfort or the perspective of the stakeholders over the organization or the company would be better or not? So considering this backdrop, we'll look at the what is essentially what is corporate governance. So basically, if we look at the definition of corporate governance, it's basically a system of rules, practices, processes by which a company is directed and controlled. So basically, at the core of this concept is the guidelines for decision making at the highest level of the organization. The board of directors and the executive team, how do they govern the organization? So basically, the objective of corporate governance is to ensure that interests of just not the shareholders, interests of all the stakeholders are protected. So we have evolved from the concept of just looking at the shareholder to the concept of stakeholders. Stakeholders would include just not shareholders, would include employees, would include customers, would include suppliers, and also the broader society and the government. So we cannot look at shareholders in isolation when we look at corporate governance. Today, the corporates are expected to step into a larger role and ensure the balance of interests of all the stakeholders are protected, and just not the shareholders, to ensure sustainable growth. A balance has to be maintained, and that is something which is required. I think it all started with Satyam Computer Services. I think this is the best example that we can take from India. It's known as India's Enron for that matter. And what we have seen in Satyam case was that because of the weak corporate governance, the lack of oversight by the board, and the audit committee was not very effective. It was because of this that the company's founder was able to manipulate the financial statements by inflating revenues. Today, if we look into hindsight, if we look into the scenario which existed at that time, if the audit committees would have been more effective, would have questioned the judgment of or decision of of the founder or the executive team, I think we would have been able to prevent a Satyam like occurrence, and the fraud would have been detected much earlier if the if if the audit committee's oversight and the internal control system was more strong at that time. So this is the time from where I think we have become increasingly aware of the need for good governance, and the fallout of cases like Satyam or Enron has been companies at 2013, which has included significant responsibilities and obligations on the audit committee and development of an internal control system to ensure the right oversight is there and right corporate governance is there over the organization. So, what are the three pillars if you look at corporate governance? I think you can basically define transparency. Transparency would mean that companies' operations, the financial statements, the decision making process are clear and understandable to all the stakeholders. Accountability would mean management is responsible for its actions. They should work for the best interest of the company and its stakeholders, and that is where accountability comes in. They should be held accountable for the actions which they are undertaking. And fairness would mean that all the stakeholders, whether it's employees, whether it's lenders, whether it's government, whether it's the society at large, all are treated equitably when the organization is being governed. So when we hear the word corporate governance, I think one group which comes to our mind is Tata Group, which is considered generally by the Indian stakeholders at large as gold standard for corporate governance. The company has been committed to all the three pillars of the corporate governance, which includes transparency, accountability, and fairness, and the way they communicate with all their stakeholders of how they are maintaining these three are a real world is a practical a real life example of how corporate governance can be projected and managed and can be structured. I think this builds a lot of trust as investors who come into the company, or any stakeholder, including lenders or the government, when they review the performance of the company. I think this corporate governance builds a lot of trust in, between all the stakeholders and the organization in specific, and also internationally. So I think this is something which we need to understand. Coming to the third concept is, if we look at corporate governance today the organization has become very complex in terms of, there's this digital transformation coming in. There's this AI, artificial intelligence, which has come into a big way in every organization, in every activity that we are doing. There are companies which are operating in multiple jurisdictions, such as technology and financial sector companies. The complexity just multiplies, because each country would have its own set of rules and regulations. Each country would have its own set of rules and regulations with respect to data protection laws, with respect to taxes, with respect to labor laws. So how you take care of these complexities is also part of corporate governance. So, for example, when we talk about internal controls, we have in India the Indian framework, wherein we focus on internal controls, which guidance which is given by the Institute of Chartered Accountants. In USA, for example, we have the Sarbanes-Oxley Act, which is very stringent requirement of putting in robust governance structures, including strong audit committees. There should be clear whistleblower policies as part of the Sarbanes-Oxley. So this entire structure which is created because of organizations operating in multiple jurisdictions and the digital revolution coming in is creating a lot of complexity, or creating a lot of challenges when we look at corporate governance. So the role of audit committees today is cannot be just restricted to financial reporting and oversight on the financial reporting. Financial reporting is just one of the many areas which the which the audit committees are required to look into. So we'll discuss all those areas, and as we move forward. So we need to ensure that these risks, whenever we design when we as part of the audit committee design a governance structure, which an ideal governance structure is something which we need to look at. We cannot live in isolation with respect to the fact that our audit role as audit committee is only limited to the financial statements. So earnings is definitely one of the core part of any organization, but just not the earnings. I think it is more important is how the other risks which are present in an organization is managed, is something which is very, very relevant. Also, this governance, when we have a structure which is in place wherein risks are identified, mitigated, managed appropriately at the relevant time. One area which is also the focus of good corporate governance is to ensure that the focus is on sustainability and not short-term earning strategy, which is there. It is regular. The fact is that there should be a focus on sustainability, and also the focus should be on 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 the right communication with all the investors. Now, again, just to give you one or two examples of failures which were there in the last 22 decades, which have shook the corporate world significantly. I think one was the Enron in the US, which resulted in introduction of Sarbanes-Oxley Act, and also a recent 2018 scam, which was with respect to Ireland FS, which was a major infrastructure financing company. We'll discuss how and why these corporate failures have occurred, and how the audit committee or internal control system, if they were more stringent, if they were put in place appropriately, I think this would have prevented the occurrence, or would have arrested, or would have been or these failures would have been detected much earlier. So I think the only answer to those failures would be a robust governance structure. There's no second option or second alternative. The robust governance structure is the only way wherein we just not ensure regulatory compliance, we just not ensure the financials uh, are in accordance with the accounting standards. We ensure that there is trust built in into the system by the stakeholders. So just so we, it's about ensuring that transparency is there. It's about ensuring that trust is there and ensures that organizations grow sustainably and ethically. I think a better value or a higher value or a higher premium is placed on those organizations which focus on a robust corporate governance rather than focus on just the business. A higher premium is placed on organization which focuses on balancing the interests of all the stakeholders and not just balancing the interests of a specific set of investors or specific set of segment of the stakeholder. So I think the role which audit committees can play and internal control systems can play is to further strengthen the governance framework is quite significant. So coming to the role of audit committees in corporate governance, we'll discuss how audit committees are role is significantly increased over the last several years. Now, when you look at 10 years back, I think the only role that audit committee used to play was ensuring that the financial reporting is accurate. They would seldom get into other areas. They would just focus on whether the financials have been prepared in accordance with the accounting standards and would not focus on whether the decisions which are taken by the management in terms of strategy decisions, in terms of business decisions, in terms of compliances would be left to the respective management or to the respective executive team of the organization concerned. They would focus only on interaction with the statutory auditors. They would focus on whether the financial reporting is appropriate in or whether the financials are true and fair. They would not get into other areas. Today, the expectation of the regulator is quite different, not only in India but internationally. Today, the audit committees are responsible just not for financial reporting but overall risk management framework, which would include internal controls, which would include regulatory compliance, fraud detection, operational risks, and even IT-related risks. I think the expanded responsibilities have become very critical because businesses have faced increased scrutiny, particularly from regulators, shareholders, and the public. And audit committee needs to ensure that organization is well protected from both these financial and non-financial risks. So audit committees the expectation from the audit committee today from all the stakeholders is to ensure that not just the financial risks are protected, but even the non-financial risks are protected. So we understand that the core function still remains oversight of financial reporting. Financial reporting, even under the scope of financial reporting, the role of audit committees have significantly increased, and the audit committees are expected to ensure that they ask the right questions to the management. So the audit committee today is expected to ask important critical questions which are on the estimates and judgments which have been made by the management in preparing the financial statements. So we, as audit committee, as part of the audit committee, cannot just form part of, cannot just uh, say that the estimates and the judgments have been prepared by the management, and therefore we are not concerned with that. So audit committees are expected to ask tough questions to the management. For example, the questions which could be asked by the audit committee to the management is how the revenues are being recognized. And is the revenue being recognized in accordance with the standard? Whether the management estimates on asset impairment or depreciation is being reviewed on regular intervals, whether there are any risks that could impact the company's ability to meet its financial obligations, whether there have been defaults in terms of the loans which have been taken by the organization concerned. So audit committees are expected to look into the financial reporting process, ensure transparency and accountability. Now let us take the example of Yes Bank, for example. The bank's financial statements were showing significant profits on a year-on-year basis, but there were significant non-performing assets which were not disclosed as such. Now, if the audit committee would have delved into the management judgments and with respect to how the provisions are being made with respect to loans, perhaps the risks could have been identified earlier. And this could have avoided a failure of or a loss of investor confidence on a bank like Yes Bank. So what is required is the questions should be asked to the management as to why the provisions have not been made for a particular loan, which is becoming sticky or recovery. On what basis are the provisions being made? Whether the provisions are adequate or not. I cannot, as part of the member of the audit committee, remain oblivious to those aspects. So another aspect which is expected from the audit committee today is to oversee the internal controls which are there, not just the financial reporting aspect. I think oversight of the internal controls is very important as part of the audit committee's role. And audit committees are expected to oversee the development and effectiveness of the internal control system, because this is what they rely upon when when to, this is what they rely upon to ensure that the organization is working effectively or the company is working effectively. For example, there could manage the audit committee can interact with the management, with internal auditors to identify the risks early and put controls in place. There should be a regular interaction of the audit committee with the internal auditors, with the statutory auditors, and even with the management to ensure that the issues which are identified or the risks which are identified are mitigated at the earliest, or proper controls are put in place before it escalates into a major financial loss for the company. So in the recent past, what I've seen is when I'm interacted as part of the auditors of as an auditor of a listed company, when I've interacted with audit committees, today the audit committee is playing a very proactive role in terms of asking the questions. In fact, it goes beyond to address the observations which have been flagged by the statutory auditor or the internal auditor. It goes beyond and interacts with the management to understand what are the steps which have been taken by the management to ensure those risks which have been identified by the statutory or internal auditors have been appropriately addressed. So, so there is so the audit committee just not so audit committee looks into a lot of areas when and and interacts quite frequently with the management to ensure those risks are mitigated. So even the other risks which are identified by the company, such as IT risks, the regulatory risk because of the change of regulations, IT the the risks relating to cross-border laws, etc. These are again being the increased focus of the audit committees today. Today, for example, if you look at certain banks which have faced cyber attacks, and there have been IT system failures because of which there have been security concerns with respect to IT. Those concerns are also being looked after or being addressed by the audit committee today. So it's just not the financial risk which the audit committee is looking into. The audit committee is also looking into the risk management as a broader aspect and understanding how the organizations are functioning as how the company is functioning from a business and a strategy perspective. There are also audit committees also expected to look into how the compliances are addressed. In the recent 4 to 5 years, for example, in the financial landscape, there has been a significant increase in the number of regulations which RBI has brought in. These regulations, again, addressing of these regulations and how the company is compliant with these regulations is another critical area which audit committee is looking into now. So the audit committee role, if you look at compared to sometime in the year 2011-12 to now, there has been a significant increase in this. And this increase in scope of the audit committee's role has cast a has resulted in increased corporate governance from a company perspective. And once the audit committee asks these questions, I think the corporate governance of the company significantly improves. So we look at so today the audit committee therefore is basically looking into financial, operational, IT related risks, and they are basically expected to be more vigilant in ensuring the governance structures are effective in identifying and mitigating risks. So therefore, to summarize, the role of audit committee has significant has is now audit committee is now playing a very vital role in ensuring that organization integrity is safeguarded, ensuring that the risks are managed effectively and the company remains compliant with the regulatory requirements. So, and basically, if the audit committee is active and diligent, the company's first line of defense against financial and operational failures is quite quite strong. So, coming to the next slide with respect to what is the role of internal controls as backbone of corporate governance. So, given this backdrop in the last 3 4 slides, we now understand that the audit committee has to play an enhanced role when it comes to organizations today, when it comes to companies today. They are expected to be more independent. They are expected to ask more questions to the management with respect to how the risks are being managed, how the risks are being mitigated. So to ensure that the risks are managed and mitigated properly, the most important aspect is to ensure that the right internal controls are there within the organization. Now, internal controls essentially would mean a set of policies, procedures, system controls within the organization to ensure that the financial and operational processes are running efficiently and the risk of fraud or risk of errors are get minimized. So you can think of an internal control system as something like an immune system of a body which protects us from any risks essentially. So internal controls would protect the organization from financial misstatements, errors, fraud, inefficiencies, and they create a framework where each process, such as procurement, such as financial reporting, such as HR, functions smoothly without any breaches or failures. So if we have a strong internal control system, if we are the auditors of an organization, our process or our audit process becomes more of a control process audit rather than a substantive process audit. We can rely on systems and processes when we are doing when we are doing a conducting a study. And even if you look at internal audit today, there has been a significant evolution of how the internal audit was earlier based on transactional events to now a review of internal controls and identify where the potential risks are there. So if the internal control system is not there in organization, the organization would probably be exposed to a significant larger number of risks, which could result in failures, which could result in the organization's downfall or huge losses for the company. So components of internal control, what would be the essential components of internal control? There would be to ensure that the financial reporting is true and accurate, performance is truly reflected as part of the reporting process, assets of the company are properly safeguarded. I think this is something which we are aware of. What are the components of internal control? So ensuring that financial reporting is appropriate, ensuring that the assets of the company, such as cash, inventory, and equipment, are safeguarded. Organization compliance risk is minimum. Organization complies with the regulations and ensure that the legal risk is minimized. Employees adhere to the ethical standards which are communicated by the company. So these are the four critical components of the internal control. Now, we can look at many examples where there has been a failure of internal control, and as a result, the company has suffered a large loss. We are all aware of a fraud which happened with respect to Nirav Modi's companies, wherein the the bank, because of lack of internal control, issued fraudulent letters of undertaking to foreign companies. Now, this resulted in a huge loss to the bank concerned. Now, if there was stronger controls would have been put in place, which was put subsequently in the bank, I think these errors or frauds would not have arisen. So, or if even if it would have been arisen, I think if the controls would have been placed, would have been detected earlier, and this would have prevented huge financial losses and reputational damage. So this could have prevented that reputation damage and of financial loss in the bank concern. So we need to be very clear on the tone at the top. So we have to ensure that these internal controls safeguard against these fraud and efficiencies. And I think one way to look at it is to ensure that we as audit committees or as auditors or as professionals play a very proactive role in ensuring that internal control system is properly developed. Even if you look at Satyam Computers, wherein there was incorrect financial reporting with respect to fixed deposit balances, it was basically due to lack of internal control over financial reporting and auditing. So if that reporting and financial reporting and auditing controls were properly present in the organization, these issues could have been flagged earlier and could have been addressed at the right time rather than it being left be ballooned and resulted in a huge loss for the investors. So therefore, the the internal controls today have to be given primary importance, and the process has to be given focus on rather than just the end result of financial. I think as audit committees or professionals, if we focus on the process of implementing the right level of internal controls, ensuring that the risks are being identified appropriately, the the corporate governance of the organization is of the company is given a big push, and the same is reflected well in the value that the company is perceived, or the perception of the value in the stakeholders is significantly increased. So, so internal controls can be looked at as a cost by the management. However, the benefits significantly outweigh the cost when the right level of controls are implemented. The internal controls and corporate governance, therefore, are linked significantly, and the proper internal control system along with the right level of interaction by the audit committee significantly improves the corporate governance by providing transparency in terms of financial reporting. It ensures the right level of ethical conduct within the entire organization. And if we look at post ILFS, for example, Reserve Bank of India has significantly introduced stricter governance norms across all the financial institutions, whether it be the smaller NBFCs, whether it be the middle layer NBFCs, larger NBFCs, or even the banks. There has been an increased emphasis on internal controls. Even we as auditors are now required to report on whether banks have an appropriate internal control system with respect to financial reporting and whether they were operating effectively throughout the year. The compliance and the assurance function has been a prime focus of RBI during in the course of the recent inspections which have happened over the last 4 to 5 years. And I think they are now required to ensure that both the functions are kept entirely independent of the entire of other operations to ensure that the compliance and the assurance functions are are given due importance and ensures, and also the compliance and assurance function or the compliance or assurance in charge is now reporting directly to the audit committee to ensure that those issues which are identified, compliance and assurance team are taken care of at the right time. So, even the regulators today in terms of Ministry of Corporate Affairs, Reserve Bank of India, or the Comptroller Auditor General, when we look at the entities which they are auditing, or even the stakeholders in general, when they look at whether to lend to the company concerned, I think one aspect which is looked at is again corporate governance and whether the internal systems are appropriate or not. And this is where we as auditors have to be very focused or specific on whether the right internal control system is there And if we are part of the audit committee or as chairman of the audit committee, we have to ensure that we have to push the organization to ensure that the audit committee, that the internal control systems are operating and developed effectively. So coming to development of an effective internal control system, there are three aspects to it. I think the first aspect is risk-based approach. We cannot have a scenario where we focus on controls on everywhere. We have to focus on identifying which are the biggest risks that the company faces. We cannot focus on all the risks that the company faces. You cannot treat all the transactions and all the events equally, all the processes equally. We need to focus our attention to the areas which poses the greatest risk to the organization. Also, the system which is required to be developed has to be a top-down risk-based approach. It cannot be an internal control system which is developing from the bottom. We have the tone at the top is therefore very, very relevant, and the biggest risk should receive the most attention. The advantage of having a risk-based approach is to ensure that our resources, which is time, money, and human resources, are allocated to the areas which are where they are needed most. For example, in retail industry, cash handling could be the significant risk area. And therefore, the focus on developing an effective internal control system would be to ensure that the cash handling is appropriate. Now, if we cannot identify cash handling as a high risk area in an IT industry, if we are putting our focus or resources on ensuring that right internal control system is being developed for cash handling in an IT system, in an IT industry, it would mean that the resources are being wasted. For an IT industry, for example, the biggest significant risk would be that the cyber security or data breaches are not there, or intellectual property. So the internal controls for us IT industry or a technology-based industry would be to ensure that the focus that intellectual property is protected, tighter access controls and stronger data security protocols are there. So therefore, the focus should be industry specific, business specific, and even company specific. We cannot focus on the on a checklist based approach and apply the same level of controls everywhere. So therefore, we need to ensure that the top down approach involves senior management, board of directors, and identification of critical areas, which, in the opinion of the management, is is critical to ensure that the risks are mitigated. This top-down view ensures a holistic approach to risk management and internal controls, and ensures that the right risks are identified. Let, let us look at examples of certain other industries and what are the significant risks which are being faced by each of the industries. For example, if we look at the banking sector, the biggest risk is that of known default or non-performing assets. So we have already discussed the example of Yes Bank, where weak controls over credit risk allowed the bank to issue loans to high-risk borrowers, leading to massive default. So again, for a banking sector, we need to ensure that right level of internal controls are built in to ensure that known defaults or non-performing assets are identified at the earliest wherever the risks are there, and appropriate provisions are made to ensure that the right action is taken wherever those non-performing assets are identified. For a tech company like Infosys, intellectual property theft or data breaches would be the biggest risk. So in which case, controls such as data encryption, restricted access, or cybersecurity audits are required to be undertaken, or should be part of the internal audits or internal control system to ensure those risks are protected. So, so we have to focus or put our resources on those areas which are higher risk and ensure that the internal control system therefore remains effective, and and that focus would result in implementing stronger controls and putting our efforts in those areas wherein the stakeholders are affected the most. So implementing basis the risk-based approach, I think one more important point is that we need to ensure that the right level of communication is being made to all the stakeholders and the employees. For example, let us take the example of a big manufacturing company. For which has high levels of inventory. For a company like Reliance Industry, for example, the inventory management process would be the high risk area. Now, how could so for a company which is engaged in petrochemical, to ensure that this inventory, which is a high risk area, we can build an internal control system to ensure that risk over such inventories are minimized or mitigated. Controls such as real-time monitoring of the inventory, the levels of inventory, automated inventory tracking as to the movement thereof, GPS-based tracking mechanisms have significant because of technology has can be used to ensure that whenever the inventories are moved from one location to another, right level of monitoring of movement is there. Internal audits with respect to the inventory levels will be carried out to understand whether inventories which are being carried in the books actually exist or not, and whether there's any loss due to operational inefficiency can also be identified at the earliest. So so of course, when we look at a risk-based approach, we need to understand from a financial statement perspective what are the significant account balances which are there uh, in the financial statements basis which we identify the areas where the risks are highest. So, for example, if let's say in a balance sheet more than 20% of the value is on account of inventory would be a high risk area. Significant amounts of capital work in progress is there in the balance sheet, in the financial statements. Capital work in progress or capitalization of property, plant, and equipment could be a high risk area. What are the controls which the company or has put in place to ensure that the capitalization is done appropriately, the right level number, right nature of expenses is forming part of capital work in progress. Only the expenses which are directly attributable and forming which should form part of capital work in progress is debited to CWIP. What is the stage of capital work in progress, whether there has been a delay in the project, whether there has been a suspension of the project. Those are the questions which or control systems which need to be put in place and these have to be put forth before the audit committee so that audit committee asks the right questions to the management and is put on record to ensure that the right corporate governance is established. Now, the third aspect is balancing of controls. Now, we have focused on a risk-based approach. We have focused on identifying significant accounts. Another, this does not mean that the routine controls are neglected. Routine controls, if neglected, could snowball into a significant misstatement or significant loss of assets or loss of or a significant uh, loss to the company because if smaller amounts can snowball into a large material amount if the routine controls are neglected. So what we need to ensure that even the routine controls, which, for example, which day-to-day transactions, which are lower risk, but still right level of control should be there to ensure that the balance is there. For example, petty cash disbursements, expense claims, etc., unauthorized spending, employee fraud. These are again areas where, although routine in nature or although which are very insignificant in terms of the volume, but there should be proper approval hierarchies in place to ensure that those risks are also addressed as part of the routine controls. So we need not overburden the employees with respect to ensuring those controls in low risk area, but maybe a multiple level of approval system, for example, based on amounts, based on quantum, maybe be decided for employee disbursements, petty cash expenses. And basically the objective is to ensure that the right balance is there. So high risk areas receive the greater amount of attention, while whereas the routine areas or routine transactions are managed with streamlined or technology or automated controls, which does not take a lot of time from a management perspective. Now, just give you a simple example in a case of a hospital where there was a huge focus on billings, patient billings. Now, patient billings were generally routine in nature, and they put in a large number of controls with respect to how the billings to the patients were made. But with respect to vendor management system, there were weak controls, and although purchases or the expenses which the company was required to, which the hospital was required to make, was quite significant. This lack of control over vendor management resulted in quite a large amount of loss for the company, and this went on unnoticed for quite some time. Now, as part of the internal audit of that hospital, when effective internal controls were established, it was realized that uh, that there was a large loss which had resulted in the company because of ineffective controls over the vendor management. It is it was so the controls which were established was ensuring that the vendor verification process, vendor empanelment was done. There was a dual approval for large contracts. Regular audit was carried out to ensure that the goods which was dispatched by the vendors were actually received by the hospital. This ended up saving significant amounts for the company in this high risk area. So focus on high risk management can deliver substantial savings to the company, and whereas the focus on routine control should be more on how the automation should be there to ensure that we do not put our focus on those automated controls. Again, let us look at a company which is having a significant level controls over procurement process. For example, let us look at a company such as Larsen and Toubro. It's one of the India's largest EPC companies, and given the nature of the projects which are undertaken by L&T, procurement is definitely one of the high risk areas. So what L&T has done to ensure that this risk is addressed and mitigated, it has ensured that a supplier pre-qualification process is there, a contract approval hierarchy is there. It ensures that the vendor selection and process payment process is tightly controlled. The company has also introduced automated systems in terms of real-time procurement system, which reduces risks such as supplier fraud and unauthorized contract modifications. So this control, when it has been put in place, has resulted in huge savings in terms of possible frauds or errors or losses or cost savings for L&T when it has implemented this control. Initial setup of the controls may still involve a cost, but once those controls are established, the long-term benefit of the success of those controls are quite material, and this reflects on the results of the company in the longer run. Today, when most of the companies are getting listed on the SME board and in the and making an IPO or making a offer for sale, I think one of the critical aspects which even the merchant bankers or even the anchor investors are today asking the company is how effective is your internal control system? What are the key risks that we have identified? If you look at the prospectus of any company, the the first 10 or 15 pages is mostly on the key risks faced by the company and how the company is making a system to effectively address those risks. Today, if you are not looking into the control system, it's not possible for any investor to come in and become a part of your company. We need to have an internal control system. We need to communicate how the control systems are established to ensure that that the investors have greater confidence upon us. So this is basically about development of an effective internal control system. So do we have any questions now, or we can take those questions and then we can move ahead with the subsequent presentation?
So we will continue with the session. After one answer, at the end, sir, we can take the session, questions around, sir.
Okay. Give me just 2 minutes. I'll just continue.
Yes.
Now we discussed about developing and establishment of an internal control system. Now, developing and establishing an internal control system is just one part. The second part is to ensure that the internal control system which has been established is monitored and reported on a regular basis. Now, we cannot just implement an internal control system and sit in silence. We need to ensure continuous monitoring is ensured that continuous monitoring is there in the organization, and for proactive risk management identification of any new risks that may emerge. For example, let us say in a technology company, internal control system was established way back in 2016. Now technology is changing every year or even every 6 months today with the advent of AI. If I'm not revising or if I'm not developing my internal control system or if I'm not adapting my internal control system to be in line with the current technological developments or identify the newer risks which have emerged in the space which I'm operating, the internal control system will be of no use. So I think the one part is establishment of an internal control system. The second part is continuous monitoring of the internal control system. Now, risks will change every year or even on a monthly basis. And if we are not monitoring these internal controls on a regular basis, we will be obsolete. And those internal controls system which we have established 2 years or 3 years back will not be effective today in developing. Will not be effective today in the right level of risk mitigation. Take for example uh, the Harshad Mehta scam in 1992. At which point of time the internal control was established around BRs, bank receipts, with respect to securities. Everything happened on a physical basis. Today, after 15 years, bank receipts are obsolete. In 2007-8, all the transactions started happening electronically. RBI developed a platform to ensure that government securities are traded on an electronic platform. The risks which were there in 1992 with respect to bank receipts are different with respect to government securities transactions between the banks in 2006 or 7. In 2000, when Ketan Parekh scam happened with respect to futures options, the risks were different. And when the shares started becoming dematerialized, the NESL scam was different. So if you look at how the frauds or the scams have happened over the last 20 to 30 years, one significant aspect that we can identify is the risks have changed over a period. And and these are those vulnerabilities which the scamsters or fraudsters have identified and exploited for their own benefit. So if we are not developing or modifying or adapting the internal control system with the changing times, the internal control system which we have established will not be of no relevance. So we need to look at internal control system on a regular basis and not just even once a year. In India, most of the organizations today develop internal control systems and just put it on paper. The internal control systems have to be monitored, reviewed, and looked at whether they are operating effectively. Not just once a year, but on a quarterly level, at least at the minimum. So if we are able to look at those internal control system on a regular basis, I think the risks which are identified or which could be which are emerging risks, which are new risks, can be identified at the earliest, and we can develop a better internal control system to manage those risks and to mitigate those risks. I think the fundamental idea that I'm putting across with respect to monitoring and reporting of internal controls is being proactive rather than reactive. If we are more proactive, I think we are able to identify the risks at the earliest. An IT-based company, for example, can undertake regular audits, regular data analytics tool, can implement data analytics tool to understand whether any new risks have emerged. They can check for breaches which have happened in the recent past in other companies in the same industry and whether those risks have been appropriately factored in while developing an internal control system within the organization. We should not wait for an event to happen in our organization to develop an internal control system to prevent the risks in our organization. Any experience with respect to other companies in the same industry can be, or even another industries can be helpful to, to, to ensure that the internal control is modified or adapted to the changing or the emerging risks. So one part is continuous monitoring of the internal control system to ensure that the risk management is managed proactively. The second part is communication of these internal control systems which we have established and the results of the operating effectiveness of these controls to the audit committee. So there should be a regular communication between the management and the audit committee with respect to how the controls are operating. And this communication should be made on quarterly basis. For example, Companies Act in India requires the audit committees to meet at least 4 times a year. So every quarter when the audit committee meets, there should be an update on what how the internal controls are operating. There should be a presentation by the internal auditors on whether there is a weakness in internal controls in any particular high risk area, whether those internal controls, whether those gaps which have been identified by the internal auditors are how are they being addressed, and and audit committee then should follow up with the management to ensure that the gaps or the risk areas which have been identified are appropriately mitigated through development of an internal control in that particular area, in that particular process. So if as an internal auditor, if as an audit committee, part of the audit committee, I am doing a quarterly review of the status of the internal control system uh, or the identification of the emerging risk or the high risks which are which are IT related risk or cyber security risk or new risks which have been identified in by the audit committee. And if those risks are addressed at the right time, the company can be prevented from a significant loss in future. If we address the issue at the earliest, I think a potential financial misstatement could be significantly avoided. And there should be a continuous dialogue between the three stakeholders, between the uh, three pillars in the organization, which is management, which is audit committee, and auditors. So if there's an ongoing dialogue between these three separate segments of the part of segments of the organization, I think the controls will continue to be relevant and effective. We should not focus just on the year-end reporting, and there should be a continuous oversight by the audit committees during the entire year. In this case, the audit reviews, the internal and external audit reviews, therefore become very relevant, and audit committees should interact with internal auditors and statutory auditors on a regular basis to ensure that these control systems which have been established are adapted and monitored effectively. Now, internal audits generally focus on process level controls which are there in the organization. Internal control would look at the controls, the weaknesses, and recommend improvements. Internal auditor is something like an organization internal watchdog and making sure that the internal controls are running as it should. So internal auditor should therefore, as a matter of best practice, should report directly to the audit committee to ensure that those controls weaknesses which have been identified by the audit committee are appropriately communicated. There's no gap or there's no communication gap between the as arising as a result of internal auditors communicating to the management directly. Rather, internal auditors should communicate directly to the audit committee to ensure that the controls weaknesses which have been identified by the internal auditors are addressed at the earliest. So, so statutory auditors' role has been more of an objective role of looking at whether the internal control system is operating effectively at the year end. So, as part of the statutory audit function, what the statutory auditor does is basically take out samples during the year to understand whether those controls which have been identified in respect of high risk areas are operating effectively as on 31st March 2024. Today, if we look at the regulations which have come up by the or introduced by the Companies Act in the recent past, such as audit implementation of audit trail, such as uh, such as enhanced reporting responsibility by the statutory auditor. The internal control processes are being looked at more seriously by statutory auditor, and the statutory auditor now is designing the audit procedures with respect to the financial statements in line with their assessment of the internal controls. So the feedback given by the statutory auditor with respect to the operating effectiveness of the internal control also plays a valuable input, also provides a valuable input to the audit committee to ensure that that the controls are operating effectively. And basis the inputs of the internal auditor and statutory auditor, audit committees are expected to interact with the management to ensure that those weaknesses which have been identified or the risks which have been identified for which the controls are not established are appropriately addressed in the in, in the course of time to ensure that no shocks come, or no shock, financial shock, or no loss arises arises for the company. So there should be a system of continuous improvement basis a monitoring mechanism which has been established, basis a regular communication, and basis a system of internal audit and statutory audit established within the company concerned. So if these three systems coexist and support each other, I think the reporting and the monitoring of the internal controls or the internal control systems will operate effectively for the betterment of the organization concerned. Now, we have discussed about the role of the audit committee. We have discussed about how internal controls are expected to be established or maintained. We have discussed about how the internal controls are expected to be monitored, reported upon by the internal auditors, by the statutory auditors. Now we look at audit committee's role in, in strengthening the governance of the corporate governance of the company. How audit committee is basis the establishment and development of the internal control system, which we have discussed in the last few slides. How can audit committee improve the corporate governance of the company concerned? So, so the first thing that is required to be done from an audit committee perspective is to question the management assumptions, which we discussed in the past. So we'll just discuss in slightly more detail with respect to how the audit committee's role would be in strengthening the corporate governance. Now, audit committee has to ask questions and probe into assumptions that underlie the financial figures or part of the financial statements. The management estimates need to be challenged. The management uh, uh, reasoning for any provisions which have been made with respect to impairment, losses, etc., required to be made. Now, if those management estimates and judgments are not sound, if the audit committee does not question those management estimates and judgments, this can significantly impact the presentation of the financial statements. For example, if there is a management bias on the estimates and judgment with respect to provision for doubtful debts, provision for expected credit loss, goodwill impairments, fair value adjustments, this could significantly impact the bottom line. Audit committee cannot live in silos and just not rely on the estimates and judgment which have been given by the management. The audit committee may look at other companies in the same industry, may look at how the industries perform, how the other companies in the industry are performing. If other companies in the industry are not showing are showing a profit which is much lesser than the profits which the company is showing, management should audit committee should ask the questions from the management with respect to how the revenues are being accounted. For example, sectors such as infrastructure, real estate, where these are typically long-term projects, and there are significant estimates involved with respect to the amount of revenues that are recognized every year, which would essentially be based on percentage completion method, which is essentially based on when the risk and reward are being transferred, whether performance obligations have been met or not as per Ind AS 115 of revenue recognition. Now, take for example the failure of IL&FS. Now, this was as a result of the financial crisis. This company made unrealistic assumptions about its infrastructure projects in terms of estimated costs and future returns. Now, the audit committee there should have asked the right questions as to how those returns or costs are being estimated. If those questions are not being asked, the right estimates are not being made, this may result in an overstatement of the company's financial results, and which is the not the right, not the not something which is good for the stakeholders. So it is therefore management estimates and judgments should be questioned by the audit committee to the extent possible. What is the basis should be questioned. Whether the basis is in line with the industry peers is something which is very important. The second part which audit committee is expected to plays with respect to engagement with the management, with respect to uh, engagement with the management with respect to the observations given by the auditors. So collaboration with auditors and management both is essential for from an effective governance perspective by the audit committee, and this effective coordination between the two would result in better corporate governance for the company concerned. Whereas, for example, with what we discussed in the last slide, the external auditors play more of an independent and objective review of the financial statements. The internal auditors focus more on the processes and the controls. A regular meeting would with internal auditors and statutory auditors in the course of the limited review and as part of the internal audit process would ensure that deficiencies are resolved at the earliest rather than when the financial statements are being signed. In one of the NAFRA orders recently, what was observed is that the statutory auditors did not interact with the audit committee to the extent which was required. So if so, statutory auditors should not just meet the audit committee when the financials are being signed. The statutory auditors are expected to meet the audit committee on regular intervals and and communicate with the audit committee as to what is the materiality level which they have derived, how is the audit process going, what are the key risk areas which the statutory auditors have identified, how are they proposing audit procedures to address those risk areas, to verify those risk areas, to ensure that the financial statements are true and fair. So there should be a dialogue or an engagement between these statutory auditors and the audit committee to understand what are the significant management judgments which has been undertaken, what are the key developments during the year which the audit committee should be aware of, whether any specific area where intervention of the audit committee is required to ensure that there is no managerial bias in respect of the profits which have been represented or disclosed by the company concerned. So there are a lot of aspects which an audit committee has required to look into when it comes to strengthening corporate governance. And if the audit committee is not doing its role with respect to these areas, the corporate governance of the company will not be improved. I think the oversight of the audit committee, therefore, is very critical to ensure that the right corporate governance or the balance of corporate governance is there, and and the and in the eyes of the stakeholders, the company is considered as something which is having a high standard of corporate governance. So again, examples again there could be pharma sector, there could be IT sector which are generally considered as very volatile. So wherever the company is having significant risks in terms of the in terms of volatile market conditions in the pharmaceutical sector, for example, the audit committee needs to understand what is the nature of risks which that company faces and whether those estimates and judgments which have been made by the management are fair. They should look at interaction with the audit committee, with the statutory auditors, internal auditors, and management to ensure that whether all are on the same page with respect to the assumptions which have been undertaken by the management while preparing its financials. So considering the role which the audit committee therefore plays in terms of strengthening the corporate governance in the company, it's not the role of the audit committee today cannot be just considered as a gatekeeper of financial reporting. It can well, it's a critical center point or communication hub between management, between the auditors and the board of directors. This governance or this effective corporate governance requires that there should be a continuous dialogue between the management, between the auditors, between the board and the audit committee to ensure that the financial reporting, internal controls, the risk management process is functioning as intended. So if these four roles or the four roles in the company are aligned and an audit committee being at the center is coordinating between the three roles, there would be a better and effective oversight over the company in terms of corporate governance. Now, to ensure independence, the audit committee needs to emphasize that the external experts such as internal auditors and statutory auditors report directly to them. So this direct line of communication between the external and the internal auditors with the audit committee and helps the audit committee to review any control weakness independently without the interference or the bias of the management. This can help the audit committee to discuss with the board to ensure the right corrective action is taken by the management and ensure that the feedback which has been shared by the internal and external auditors are effectively implemented. This results in audit committee playing a more proactive role in strengthening the corporate governance and and, and having a better perspective, a better value from the stakeholders' perspective. Coming to uh, a specific risk area, which is respect to fraud. I think this is apart from the other risks which we have identified as part of development of the internal control system what the audit committee identifies. One area which is become very relevant in the past 5 to 10 years after the corporate scams have been identified in terms of failures have been identified or audit failures have been identified in a number of companies such as Cafe Coffee Day, Reliance Communications, certain the ILFS or Satyam. The fraud risk management has become significantly critical. And if you look at today, wherein due to globalization, due to digitization, remote work, the opportunities for fraud are ever increasing. So organizations today are not just susceptible to the financial risk, but they're also vulnerable to cyber fraud, vendor fraud, and employee fraud. So wherein the employees exploit weakness in the company's control system. So role of the audit committee in fraud risk management has assumed significant proportion in terms of fraud detection and prevention. So if you look at how fraud risk needs to be managed, it's just not about having a having a system in place. There should be a collaboration across departments to ensure that fraud risk is mitigated at the earliest. So the fraud prevention is not just the responsibility of, let's say, a finance department or the CFO or the management or the board. To effectively manage this fraud risk, the companies need to ensure that there is coordination across different departments such as internal audit, finance team, compliance team, legal team to ensure that the right strategy with respect to fraud risk management is developed and implemented. For example, finance committee will probably identify unusual transactions, but without the input of the internal audit, they may not be able to identify whether this is a systemic issue, whether there is a lapse in the control system which needs to be addressed immediately. Or, for example, the legal department which could understand the implications of this risk, or the compliance department which who may understand whether this fraud which has been risk or the unusual transactions which have been identified needs to be reported to any regulator. So if the cross departmental cooperation or the coordination between all the departments which are there, such as finance, legal, compliance, and internal audit, is not there, the development of a fraud risk management strategy is flawed essentially. So the audit committee needs to ensure that the fraud risk management strategy takes care of this coordination among the departments and ensures that the system is developed in a manner such that the fraud risk is minimized to the extent possible. Now, today, if you look at banks, because of the intervention of Reserve Bank of India, early warning system has been implemented. What is early warning signal is something wherein if there is a EWS alert which is there, which has certain parameters which have been identified, such as ratios uh, not being in accordance with the industry, increase in stock significantly, qualifications in the audit report. There are 32 or 33 parameters for identification of early warning signal. If those early warning signals are identified, uh, this is part of a fraud risk management to understand whether a particular borrower could potentially slip into an NPA. There are systems which are being developed by larger private banks to ensure that unusual transactions, whenever they are undertaken in any account of the borrower or depositor, they are flagged to the risk management and compliance team to understand whether there could be a potential fraud risk on account of those transactions. So this collaboration between the departments and the development of an early warning signal or a fraud risk management strategy is required to ensure that the fraud risk is mitigated. If this collaboration is not there, or if for example, even the IT department therefore is required to play a critical role in this coordination to ensure that the frauds are identified at the earliest and fraud risk is mitigated at to the extent possible. One more aspect that needs to be looked at when we look at fraud risk management is a proactive fraud risk assessment. For example, in highly regulated sectors such as banking, pharmaceuticals, these risk assessments are very, very critical. Today, the RBI requires each of the banks or NBFCs to conduct a fraud risk assessment. Whether there have been instances of fraud uh, in uh, in account transactions, for example, in cyber security breaches, in customer data being leaked, or any aspect which is considered as fraud by the fraud for the entity concerned. So this fraud risk assessment is required to be conducted on a is being conducted on a periodical basis to ensure that those risks which are identified as a result of those assessment are appropriately mitigated through development of proper internal control system. For example, in pharmaceutical industry, there could be frauds relating to drug approvals, clinical trial data. There could be possible manipulation which can take place with respect to these two areas. Now, if the regulatory compliance team does a fraud risk assessment at regular intervals in collaboration with the internal audit team, the risk of fraud can be identified at the earliest. And if that risk is identified, proper internal control system can be developed and implemented by the company concerned to ensure those fraud does not fraud risk does not actually result in a fraud after some certain time. Now, this proactive fraud risk assessment thus helps the company to to identify the vulnerabilities at the earliest, and this vulnerability, whenever it is identified, will result in prevention of a significant loss that may incur at a later stage. Again, an example of a housing finance company, for example, which was not conducting these fraud risk assessment, faced allegations of fraud with respect to irresponsible lending practices. Now, if those fraud risk assessment was conducted at regular intervals for that housing finance company, the 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 company would have been able to identify fraudulent loan applications which have been made by companies. There could be a stronger verification process which could have been undertaken. There could background checks and third-party validation could have been carried out to understand whether any borrower is not the right borrower to which the loan should have been or the credit risk should have been underwritten. This proactive approach would minimize the risk of fraud before it becomes a material issue. Today, with the advent of technology, I think cyber fraud is again one area which the companies are required to proactively manage. There has been Data Protection Act which has been introduced, the European GDPR laws which have been introduced, which are which require you to ensure that the data, customer data, vendor data, and the data which the company has is protected. And the IT risk, therefore, has become a significant risk in terms of touching the fraud risk area also. So these are areas which the companies should look at when it comes to fraud risk management and ensure that the fraud risk management is appropriately mitigated. The bigger problem of fraud is risk is basically the reputational damage that it comes with. So if the fraud risk assessment or the fraud risk is not managed from day one, uh, fraud risk which if not managed may result in a fraud may result in a significant reputational damage to the company concerned, which is irreparable. Financial loss is just one part. Reputational damage can create a larger affect on the system or can affect the company significantly the uh, rather than just the financial risk. So so just to conclude on the fraud risk management, I think we need to ensure that a constant vigilance, continuous assessment or monitoring over the fraud risk or the risk assessment, and a multi-departmental approach is required to ensure that the fraud risk is managed and mitigated at the earliest. If this is done, I think this really improves on the corporate governance and the audit and the oversight of the audit committee and the auditors on the company concerned. The second aspect, when we look at ensuring the right level of oversight over the company or ensuring the right corporate governance, is to ensure ethical conduct and compliance. The company, so so one of the key pillars of good governance is to ensure that ethical behavior is ensured throughout the organization. The culture internally should be established such that there should be honesty, integrity, and transparency as the core values within the organization, and there should be a reward, or there should be a reward for ensuring right ethical conduct is maintained, and there should be severe punishment for for instances which are brought as unethical or considered as unethical behavior. So companies should ensure that the right code of conduct, which is expected from all employees at all levels, should be there, including anti-bribery, insider trading, how employees interact with customers, suppliers, etc. Today, if we look at the increase in the investment in the capital markets in the last three post-COVID era, we'll realize that insider trading is one of the significant areas which SEBI is looking in. These controls, these policies, these ethical behaviors should be brought in into the company to ensure that the employees are aware and employees actually follow them. The code of conduct should be communicated to all the employees concerned, and ethical training programs should be undertaken by the company to ensure that all the employees are aware of the ethical policies which are there. So one aspect of ensuring ethical conduct and ensuring compliance is the development of a whistleblower system. So if we look at whistleblower systems which are there, whistleblower systems should not be just on paper. Whistleblower systems should be there, should be communicated to all the employees, and there should be a system where any of the employees or any stakeholder can communicate cases of fraud, harassment, conflicts of interest anonymously without fear of retaliation or losing their job. The audit committee should ensure that this whistleblower system is functioning effectively and it is accessible to all the employees concerned. So just having a system on paper is not good enough. The audit committee should ensure that this whistleblower system which is there should be rightly communicated. Employees should feel comfortable using this system, and they should look at whatever the grievances that have been raised by the employees, how are they addressed by the management concerned. So there should be so audit committees should ensure that right level of awareness is there with respect to the whistleblower policy, which is communicated throughout the organization. Now, example, if we look at the larger companies which have stronger corporate governance, they have created some sort of a whistleblower hotline, which or some sort of an online portal wherein the employees are able to report all the complaints anonymously without fear of retaliation from any management or manager. If this whistleblower policy is communicated across organization, I think this improves the company's image from the internal stakeholders or the HR or the human resources of the company or the employees of the company, which gives the company a big image boost in terms of how the company is looked at when dealing with cases of complaints by the employees. So if this whistleblower hotline or whistleblower process is developed, the chances of detection of several instances of fraud may get noticed, which might otherwise be get unnoticed. So what happens is development of an whistleblower, all the employees becomes the eyes and ears of the organization, and any issues or any red flags which are identified are flagged to the audit committee at the earliest, so that audit committees can then take a proactive role in ensuring that ensuring those issues which have been identified are addressed. We have discussed about ethical governance. We discussed about addressing IT and digital risks. So ensuring ethical conduct and compliance. Another area which is very important is ensuring that the IT and digital risk in terms of protecting sensitive data is also protected. So today, if you look at each organization, we cannot be independent of the technology which is there. So all organizations today have to interact with AI-based tools, interact with technology, and there's a lot of data which is available on the dark web. So there could be organizations who could face issues such as data breaches, cyber attacks, unethical use of customer data, which can significantly damage companies' reputation. So the right controls should be there to address these IT risks. For example, ensuring that data protection policies are in place, to ensure compliance with Information Technology Act, to ensure that Personal Data Protection Act is complied with, GDPR regulations are complied with if the company is operating in Europe, for example. Cybersecurity framework should be established to protect against attacks. We should monitor how customers' data is collected, stored, and used. So if these IT and digital risks are addressed, I think again this is a significant area where it can result in a reputational damage to the company. This helps us in building in trust amongst the stakeholders to ensure if the right level of IT and security systems are put in place. For example, this is most significant in entities which are operating in information technology space or in banking financial space, which deals with a larger number of customers. Today, banks collect sensitive data with respect to Aadhaar numbers, with respect to personal social security numbers, with respect to personal data, and this data which is collected by the financial institutions or by any party with respect to customers, borrowers, this should be protected protected, and risk should be managed to the system should be developed to ensure that this is properly managed and mitigated. If these are not managed or if these IT risks are not managed, this could bring a significant reputational damage for the company or the bank or the institution concerned. So if you look at role of the audit committee in ensuring ethical conduct and compliance, the audit committee should oversee how the whistleblower policies are there, how the whistleblower policies or systems which are there are communicated to the employees concerned, how the emerging IT and digital risks are identified and mitigated, how the company's reputation is protected from the ethical failures which can arise as a result of data breaches or cybersecurity attacks. So if you look at again companies such as Wipro, such as ITC, such as Dr. Reddy's, ICICI Bank, these entities have taken proactive efforts and ensuring right level of communication is being made as to how the risks are being managed. So this ensures that the right environment is created to ensure that transparency and accountability is there running through the entire blood of the organization. If we explore, if we are able to, if as an audit committee, if we are ensuring this ethical conduct and compliance, this goes a long way of ensuring that companies' corporate governance is significantly improved. Now, coming to integration of risk management into corporate governance, we looked at a lot of ideas with respect to development of a risk internal control system. We looked at how audit committee should ensure right fraud risk management, how ethical behavior should be incentivized, how unethical should be taken to task, how whistleblower policy should be implemented. Now, coming to ensuring that this risk management is integrated as part of corporate governance, here the risk management is not just limited to financial risk management. Now, audit committee should look at being part of being part of the board. The audit committee should look at being proactive with respect to how the risk is identified and mitigated. Audit The role of the audit committee is quite critical in terms of not waiting for a risk to be materialized, but understand what risk could arise in the company concerned. For example, let's say if audit committee of a company which is engaged in manufacturing of motor vehicles, the audit committee could potentially interact with the management to understand the risk which could arise from climate change and fuel regulation shifts. So this can, for example, the audit committee can discuss on the risks which can arise as a result of the climate risks and the fuel regulations shift, and they can make a decision with discuss with the management to take a decision with respect to development of alternative models such as electric vehicles or hybrid vehicles early on to ensure that those risks, whenever it arises, are effectively managed. They could possibly advise the management, discuss, interact with the management to understand and create a right balance to understand that those risks are mitigated at the earliest before those regulations come in or kick in. So, so audit committee should identify all the risks and align and ensure the organization aligns its risk management strategy with the company's long-term goals to ensure it remains sustainable. So what is expected from the audit committee is to ensure that this operational, financial, and strategic risk management is aligned and ensure a holistic approach is undertaken by the audit committee to ensure that that entire risk management is integrated with the concept of corporate governance. So let's say a company which is expanding into international expanding into international borders. For example, let's say a company expanding into Africa. The audit committee should closely work with the management to understand, to assess the regulatory, operational, and political risks involved. So, audit committee should not just wait for the business to be undertaken, should not wait for the business or the company to go there and then realize that they have not assessed the required risks to mitigate any issues which may arise. So whenever there is a strategic decision which is being taken by the management, the audit committee should understand the risks associated with that strategic decision. They should look at whether the risk management framework which the company has established is aligned with the overall expansion strategy which the company is developing. So take for example, again, the company which is entering the African market may identify risks such as foreign exchange fluctuations, local regulations, infrastructure challenges as the significant risks. And those risks, if those are addressed at the earliest, I think as a company, it will be very smoother for the company for it to enter into the foreign market. It will not be difficult if the risk is identified and mitigated at the earliest. So the so this risk intelligence or this risk identification, if done earlier, it helps the company to forecast potential risks relating to any economic downturn or technological advancements that could disrupt the industry. If staying ahead of these risks, the companies can therefore develop strategies to help them navigate uncertain business environments. So therefore, the audit committees should focus on just not the past of the company, which is developing internal control systems, then looking at the financial reporting, but ensuring that the right risk management is aligned with the strategic objectives of the company concerned. The audit committee should actually expand its scope to ensure that the financial, operational, and strategic risks are also looked at to ensure that the company is well prepared before those risks actually arise. Financial risk could include risks such as liquidity risks, credit risk, foreign exchange risk, which could arise as a result of company expanding into foreign countries, which could arise from a possible downturn in the economy, which could arise from a significant foreign currency loan being undertaken, Operational risks could be due to cybersecurity attacks, could be day-to-day operations, supply chain disruptions. For example, when Tata Motors acquired Jaguar Land Rover, the audit committee there was quite instrumental in ensuring how Tata Motors handled those risks, from managing supply chain complexities to ensure operational synergies between the Tata brand and the Jaguar brand. So these risks, if are identified and mitigated at the earliest, this ensures that the company's success is there in the longer run. With respect to strategic risks, again, these are the company moving into certain mergers, acquisitions, new product launches, entering new markets. These strategic risks again can be uh, can be identified before the company enters into those markets or enters into those business acquisitions, and those risks are looked at, and by an audit committee actually understands as to how those risks which are identified are mitigated by taking necessary steps. This helps in ensuring that the company's strategic objective is aligned with the longer run goal of ensuring profitability and sustainability of the company concern. So, integrating this risk management into corporate governance, it's just not about preventing financial losses for the company. It's ensuring that the company pursues its strategic objectives with confidence, with ensuring that risk is proactively managed, whether financial, operational, and strategic. And the committee can ensure that organization can face resilient in the face of uncertainty. So ensuring that resilience is there in terms of just not financial risk, resilience is there in terms of operational and strategic risk is something which audit committees could possibly play a role in the times to come to ensure that the corporate governance is further strengthened by the company concerned. So this helps the stakeholders as such to understand that the audit committees, which are essentially independent of the board, independent of the management, are playing a more proactive role in understanding that as these aspects are appropriately addressed. I think we have discussed the IT and operational risks with respect to how cybersecurity, digital transformation, and globalization is affecting the IT and operational risk. Again, this is one area where audit committee can again play a proactive role today in terms of ensuring the security systems are in place, security assessments are carried out, vulnerability assessment, penetration testings are being carried out by the management to ensure that those cybersecurity or breaches or digital transformation is appropriately carried out. Today, with the advent of artificial intelligence, the audit committees need to play a more proactive role as to how much AI should be brought in into the organization. What should be the right balance between AI in the organization and manual tasks which are being undertaken? Which areas are the processes where AI can be used? Whether those would be low whether those would be routine processes which take a significant amount of time, or would it be sensitive areas where probably AI may not be very is not it may not be the right time to use AI. So these are something which can be evaluated and can be looked at. Those risks can be assessed by the audit committee, and audit committee can therefore work with the management to understand whether those risks are appropriately factored in. They can put in their expertise in their respective areas to understand whether these IT and operational risks are appropriately factored by the company by before taking a particular decision with respect to implementing a new system or new IT or process in place. Coming to coming to the common pitfalls and lesson learned with respect to the last 10-15 years, I think one area where audit committee should be specifically be very vigilant about or careful about is not to over rely on management. This has been the biggest failure of the audit committee in the last 10 to 15 years, wherein audit committees have been simply has simply gone with the management bias. Audit committees must actively ensure that they identify and address the emerging risks and not solely rely on management reports. Audit committees must challenge the management with respect to whatever decisions that they are taking. They should just not look at management as the sole decision maker. They should question whether the decisions which are being undertaken by the management are based on sound reports, sound research which has been undertaken by the management, and whether all the risks which are identified by the all the risks which are there in a particular decision has been appropriately identified when the decision is being taken. So this is very, very relevant when the audit committee comes in and ensures that the over reliance on management is not there. There should be there should be a failure to there should be a on another important area is when we look at the past is audit committees with respect to audit committees, that there should be an ongoing training with respect to the audit committees. Aud- the role of the audit committee should be discussed, should be communicated to the audit committee members. The continuous training should be there, so that they should be aware of the best practices, regulations which are there in the industry. This really helps the audit committee members to play a proactive role and understand what their role is in as part of the board, as part of the uh, members of the audit committee, and what are the questions that they can ask the management with respect to the decisions which are being undertaken by the management. So audit committees may possibly may not be aware of the new risks which are there, may lack the knowledge and skills. The audit committee members, therefore, should be well diversified, each from their own respective area, to ensure that the corporate uh, or the company, to ensure that the corporate actually takes the benefit of the variety of experience which is there in the audit committee members. So this helps the companies to identify the risks or the emerging risks which are there. Also, the past governance failures which have been there in terms of Satyam, be it ILFS, be it CCD, be it any other company, be it Enron or Global Trust Bank, we should learn from them. We should understand what failures have, what are the reasons for the failures of those companies concerned. What could have been changed, or what role could the audit committee have played alternatively to ensure that those failures would not have occurred, or failures would have been identified at the earliest before it spiraled into a larger sum, or a larger financial loss for the company. So what practices should the company adopt, or what practices should the audit committee adopt today to ensure effective governance is something which each of the audit committee member today should think about. They should look at each of the past failures as a case study to understand where corporate governance can be improved in the organization. How how there was a failure to address the emerging risk. How they can engage in continuous training to understand the new risks, and what are the control systems that should be established. What are the international best practices that should be adopted in the organization. So these aspects should be can be very helpful for the company to, or the audit committee members to, uh, or these learnings can help them to ensure that the organization actually helps uh, in, in better corporate governance, and ensure audit committee plays a better role in terms of addressing the requirements or the expectations of the regulators. Future trends, we have again discussed when we went through the presentation. One important area which I would discuss here is with respect to ESG. Today, today the trend is not to satisfy or not to report only to the shareholders. The trend is to look at all the sections of the stakeholders. The term that is now used is stakeholder and not just shareholder. Management, although stands in a fiduciary responsibility to the shareholders, management is also standing in a fiduciary responsibility to the other stakeholders, such as employees, such as government, such as society in general, such as regulators. There is an increased focus to ensure balance is maintained, balance of interests of all the stakeholders are protected. And that is where ESG has come in. So ESG is therefore it's just not something which is required to be reported as part of the financial statements or as part of the annual report, which is given to its shareholders. It's more about ensuring that more of transparency is there with respect to how the companies are addressing climate risks, with respect to labor laws, with respect to diversity in the board, diversity in the management. So audit committees should look at how the ESGs just not look at ESG reporting, but look at how the companies are actually putting in action the commitments which are made as part of the ESG reporting. Whether those ground level actions are being undertaken by the management is something which the audit committee should look at before when it comes to future corporate governance. I think this is something which is very very relevant and something which is increasingly gaining prominence internationally across countries. Whether the businesses which the company is engaged in, whether climate risks, whether the employee engagement, whether the society in general, how are those aspects being taken care of by the company is something which is looked at by the international investors, by the regulators to understand whether the company is ESG compliant. And it's more of action that needs to be seen rather than just reporting on how the company is compliant with the ESG standards. Coming to the closing thoughts with respect to the discussions that we have covered in the last several slides. So, so basically, we understand that audit committees essentially play an important role in overseeing financial reportings, managing risks, and ensuring ethical conduct. But now the responsibilities have significantly widened. It's just not the internal control system that audit committee should be responsible. Audit committee should look at risk systems in more generic level, is more of futuristic in terms of how, in terms of being proactively participating in terms of identification of risks at the earliest. So they should look at ensuring that the company is very, very strong or having a very gold standard in ensuring the right level of corporate governance. So value of corporate governance is just not preventing fraud or ensuring compliance. It has to ensure that the confidence is built in with stakeholders. The trust has to be communicated to the stakeholders. The trust has to be established in the mind of the stakeholders. So it's just not ensuring that fraud is prevented. It's just not ensure that we do a checklist based analysis as to that we have complied with all the regulations. It's just the real test of corporate governance comes when the stakeholders have confidence on the company, when the stakeholders have trust that yes, this company has a strong corporate governance. If if that trust and confidence is established, I think audit committee's role has been. It can be said that the audit committee has played a successful role in ensuring that the right level of corporate governance is there. Audit committees should therefore be vigilant, well trained, forward looking, and therefore when you look at trust, I think the audit committees are the uh, uh, first body which the stakeholders look at to ensure that the right level of trust is being maintained, because they are supposed to be independent of the management, independent of any other person who is there in the organization, and their oversight and their actions or their intervention with respect to the working of the company, with respect to identification of risk, goes a long way to building that trust and confidence in the mind of the stakeholders. I think this is what it is. Any questions which you may have is we can take those questions. Any questions which is there? Nisha ji, Seema ji.
Hello, sir.
Yes. Any questions
Am I
which are
audible?
there? Yes, yes.
Thank you so much, sir, for the session. There are a few questions the participants have sent. Can I just ask you some of them?
Yes, yes, please.
Yeah, sure. So, first question was, how does the effectiveness of internal controls contribute to risk management in an organization?
So if we so internal controls and risk management are both intertwined in terms of if the right level of internal controls are established, the controls help to ensure that those risks. So the part of the process of implementation of internal controls is to ensure that the right level of risks are identified and what are the controls in place to ensure those risks are managed and mitigated. So this is basically how internal controls would interact with risk management.
Okay. So, thank you, sir. Second question is, how often should audit committee review the adequacy of internal controls?
So this is what we have discussed in the course of the presentation also. The audit committee should essentially interact with the internal auditors and the statutory auditors and understand what are the control systems that are put in place and whether those systems are operating effectively. If the internal auditors and or statutory auditors have flagged certain concerns with respect to the right controls not being there, audit committee should proactively take up the issues with the management to ensure that the right level of systems are developed to ensure that those control lapses do not occur and any risk areas which are there are identified at the earliest.
So the next question is, uh, how can an audit committee ensure that the internal control deficiency are addressed promptly?
Sorry, could you just repeat the question?
How can audit committees ensure that the internal controls deficiencies are addressed promptly? It's just interrelated to the first question
Yes, I
itself.
think it's
Next question is, what metrics or reporting mechanisms should be placed for audit committees to ensure monitor internal controls?
a reporting mechanism should be to understand from the financial statements to understand the nature of the business of the company concerned and basis this the audit committee should understand whether the management has identified all the high risk areas which are there. If those high risk areas have been identified appropriately, the next stage is to develop the internal control systems basis those risk areas. If the audit committee feels that all the risk areas have not been identified basis their understanding of the business or the industry, those risk areas can be further identified, discussed with certain experts, and basis those risk areas which have been identified additionally by the audit committee, internal control systems can be developed to ensure those risks are also appropriately dealt with by the management.
So many questions are there, but I think we are do got a paucity of time, and so I'll if there are any questions, furthermore questions, we'll be happy to take. But I think there are no more questions as of now.
Mhm.
So on behalf, so I think I it's good to conclude the session, sir.
No,
So
so we are
sure,
completed with the session. So I
yeah,
don't think there are any other questions. So we can probably close the session if that's okay with you.
yeah, because presentations and your explanations were so well defined, and I think there won't be any more questions. That's the reason. So let me officially just and conclude today's session. So, it's my privilege and honor to propose a word of thanks to Vivek sir. So in his busy schedule, he took us the time and enlightened with us the today's topic. That's the internal control and audit committee strengthening the corporate governance through the effective oversight. So on behalf of committee chairman Dr. Debashish Mitra sir and all the committee secretariat, I extend my heartfelt thank you for your time and your knowledge sharing. Thank you so much, sir.
Thank you. Thank you. Thank you.